Well, welcome everybody. We're going to wait a few more minutes until more people come in and tune in. But for those who are already here, thanks for joining us. Together we have the dream team. We have Eli, our global head of research, tuning in from New York, myself, Adrian Fritz. And yeah, there's a lot going on in the market these days, a lot of questions, maybe a bit of anxiety as well, but we really want to give a quick market update. We're going to take the next 15 minutes. Eli and we will be dissecting what's going on in the market. Should we be scared? Should we be optimistic? And how should we, what can we expect from the market going forward? But first of all, good morning, Eli.
Good afternoon, Adrian. We're not in the same location, so that's why we had to switch up the, the timing. But how are you?
I'm doing well, actually. Once again, a lot going on in the market, but as you and I know, we've been here for many cycles, and I think it's good to bring a bit of our expertise and see how we're reading the whole thing.
I agree. I don't see any gray hair yet, but maybe it's because of the water that you're drinking or that we are drinking. But no, it's great to be here, and we're excited to have you guys to spend some time with us, at least for the first 15 minutes. We're going to walk you through how we're thinking about the markets, and also going back to what Adrian and I hosted a few months ago to present the Bitcoin history when it comes to the bear markets and how to define them. So I would say let's get started. Let's go first with the history of Bitcoin bear markets. So as you guys may know, a bear market in traditional finance is defined as when the price is coming down by more than 20% from the previous all-time high. This is when the definition of a bear market starts. And before, of course, the 20% drawdown, we're talking about a correction. So historically, we've seen since the launch of Bitcoin in 2007, so there are two types of bear markets, and there are common catalysts that drives these bear markets as well. So let's go through the two types of the bear markets first. The first one is the cyclical bear markets that last about 2.5 years, where the drawdowns are actually on average for Bitcoin of over 84% from the previous all-time high. The second one is the short-term bear markets that do have an average drop of over 36% from the previous peak, but on average it lasts about 2.5 months to 3 months before they recover to new highs. So in that specific case, of course, right now we are in the second phase, which is a short-term bear market, where basically the price of Bitcoin is roughly around more than 35% down from the all-time high. And after the October 10th crash, right now, of course, we are already 3 months in, and that's why we're going to really monitor the market very quickly. When it comes to the common threads, there are 5 main forces that historically drove significant drawdowns for the Bitcoin markets. So the first one is security breaches and operational failure. Maybe some of you don't remember, but 11 years ago, 12 years ago, Mt. Gox, the largest crypto exchange in the world at that time, with over 70% of the Bitcoin supply, completely failed and lost a significant amount of Bitcoins out of the blue. The second one is fraud, governance, as well as and collapse specifically. The most recent one that I think brought PTSD for many investors is FTX, right? But there were many similar cases as well in the past, in 2018 as well as in 2011, with Bitcoin Connect, BitConnect specifically, and then Bitcoin Savings and Trust. The third one is speculative excess and lack of guardrails, right? So many people, many of you heard about meme coins and NFTs, and of course also ICOs, initial coin offerings. So this is when we have bubbles. When bubbles form, when there is excess in capital investments, and there is a lack of risk management. The second one, the fourth one on the right-hand side is the regulatory clampdowns and the concentration risk. So for example, specifically, of course, recently in the US, we've seen some regulatory crackdowns, so regulation by enforcement in the previous administration, but also in 2021, we also experienced the China ban, where the CCP decided to completely ban Bitcoin trading as well as Bitcoin mining. And then the last one that is very important, because Bitcoin and crypto is a macro asset, and it's incredibly important to also look at the micro tightening cycles. The micro tightening cycles were also the last, but also most importantly, one of the most important forces that drove the prices down. And we've seen that, of course, in 2018 as well as 2022, that basically coincided with the central bank putting down liquidity out of the system, right? So if you really have to remember these five forces historically to have a framework and a mental model in your mind, you have to look at security bridges, fraud governance, speculative excess, so basically bubbles, regulatory crackdowns, and I would say last but not least, macroeconomic tightening. And for now, of course, we haven't seen macroeconomic tightening, right? We haven't seen fraud specifically. We've seen, of course, speculative investments in meme coins more recently, especially last year when the president of the US launched its own meme coin. But we haven't seen strong regulatory clampdowns or even security bridges that basically drove the market to be concerned over the reliance of crypto investments. All right, Adrian, where are we right now in the Bitcoin markets? As we mentioned, we haven't seen major forces that drove the prices down, despite the fact that, of course, for asset allocators, AI, biotechnology, and robotics are exciting investment opportunities as frontier technologies, more so than Bitcoin, I would say, for now. But it feels like we're in the accumulation phase, and we've got three main scenarios that I would love to hear from you.
No, absolutely. I mean, you spoke about what defines a bear market and what triggered it in the past. But I think we all agree that we are in a bear market right now. I think the big question is, when does it end? Or at what stage of the bear market are we? And what could be the potential scenarios going forward? Of course, we always like to play with a base, bull, and bear case. And I would say on the bear case scenario, there are some catalysts at the horizon, but if they don't play out, it could have the negative effect. Of course, in the US, we're talking about the Clarity Act. There's been a lot of back and forth between regulators. It's still uncertain when this will actually come out and if it's favorably written for the crypto industry. But obviously, any kind of delay or hawkish tone in regards to that bill could have some downward pressure. Another big case is liquidity. I mean, October 10th obviously flushed out a lot of liquidity of the entire market. While it has come back, it's very selective and still very scarce. And therefore, obviously, we still got to wait for returnal. And if that doesn't happen, we see liquidation waves or price actions like over the last couple of weeks. Those are kind of like, some macro events. And usually it hits the order books with very thin liquidity, and then you get those violent steps downwards like we've seen recently, unfortunately. I would say the bear case, which is not necessarily a bear case, is that Bitcoin consolidates even longer, but that we also might even go further down. And we talk about it in a second, about kind of like the potential key support levels, but that we might not have seen the final capitulation yet. The bull case, obviously, that's regulatory movement. It's actually, there's a concrete timeline. I think that could spark some enthusiasm and especially sentiment in the market, because sentiment is at absolute zero right now. Also, monetary policy turning. I would say another reason for the recent sell-off in equities, but also the spillover in crypto, was obviously the announcement of Kevin Walsh as the new head of the Fed, and therefore, he's been known for having kind of like a hawkish stance, especially in regards to balance sheet expansion, and therefore that counteracts a bit the liquidity promises that we were expecting. Yeah, you wanted to add something, Eli?
No, I couldn't agree more with you, especially on the expectations of the new Federal Reserve chairman that we're going to have in Kevin Walsh. Uh, I would say more recently, he also agreed upon the policy of Donald Trump to lower the rates, which is a little bit not in line with his historical views, especially over the last 20 years. But I think the Federal Reserve independence, of course, with 12 governors, is going to be incredibly key to monitor as well, despite the fact that we have a new head coming in May this year.
Absolutely, absolutely. I would say the macro setup actually looks pretty good as well. We a few days ago we got the new PMI manufacturing index,
Yep.
and for the first time since a couple of years ago, we finally broke that magical 50 that 50 number, which basically says that the economy starts to grow again. There's more confidence, and therefore usually that spills over into an equity rally, and is more favorable for risk on assets. Let's talk a bit about trend analysis, because I know a lot of investors want to know what could be happening in the next couple of weeks and months, and let's look at charts, because obviously the price tells you the story. And as we can see, obviously since October last year, it's been quite a violent breakdown. We lost some key support lines. I think the first indication was the loss of the 50
Yeah.
week moving average, exactly. And ever since we've been trending down. I think at the moment this is a really important area, somewhere between 70 and 75, because as you can see, we had a longer consolidation phase in the past, and therefore the price is holding on around that area.
Yeah.
Now, what we can see though from the price action, there hasn't been any confident move to the upside. Let's be honest, as of today, Bitcoin shows some weakness. There is a risk that we might go down further, but I would say the major support line would be the 200 moving average that we see in purple here. And that's kind of like a multi-year support line. It also coincides with the so-called realized price of Bitcoin. And for those people who are not aware of the realized price, what it actually means is the aggregated purchasing price of the entire network. So every time Bitcoin is being sold or changes hands, it captures a price, and if you aggregate that, it gives you the realized price. And the realized price and the 200 moving average, they coincide around that 56 or 60K level. I would say that's kind of like the worst case scenario. But in my personal opinion, it's also one of the bigger opportunities, because historically speaking, those have been good opportunities to load up. No financial advice, of course. Eli, what do you think? Will we
Great,
see kind of like a move to the upside, or what's your take?
great disclaimer, Adrian. I love it on the financial advice. Um, I couldn't agree more with you. And I would say for the investors that never heard about realized price, think about it as the cost basis of your investment over the last 10 years, aggregated with all the investors that got into Bitcoin over this time horizon, which is a very interesting metric. And the beauty is because blockchain transparency is transparent, and we're able to analyze, of course, the investments across multiple timelines of all the investors that got into Bitcoin early and also recently as well, which is super, super exciting. And of course, if you have any questions on that specifically, we're going to host a Q&A after our presentation as well. When it comes to actually on-chain transparency and analysis, Adrian, what are we saying right now? What is your crystal ball?
Yeah, I mean, we're starting to see people capitulating. What we can see here is the net realized profit and loss. So people actually taking profits or losses. And as you can see, of course, over the summer last year, we've seen a lot of profit taking. We all know that a lot of kind of long-term holders or Bitcoin investors from the early days sold off some of their holdings, and that was one of the reasons why we've seen that price action in recent months. But now we could also see some short-term holders that came in late, capitulating, basically saying, okay, yeah, I can't stand the recent price action, and they're basically selling at a loss. Is that a good thing or a bad thing, Eli?
No, but I think it's depending on investors' profiles, and I would say also the thesis that they have and the time horizon that they do host for holding on to Bitcoin. I think one thing to highlight from what you just mentioned, Adrian, is that most of the selling pressure, especially in market corrections and stress, as we've seen more recently, they're really coming from investors that got recently into the asset class. And we've seen that pattern happening over and over again for the last 12 years, or at least I would say for the last 6.5 years, since we've got more, I would say, a track record around on-chain data to better understand that. And usually, on average, the investors that actually sell in these market corrections are actually investors that bought Bitcoin over the last 18 months on average, right? So we're not talking about long-term fundamental driven and thesis driven investors that basically got into this asset class probably a while ago, like 5.5 years ago or more, to be able to get exposure to an emerging store of value like Bitcoin itself.
Absolutely, absolutely. Maybe let's move on to the next slide, because I
Yeah.
think that's an important dynamic as well. Here we're looking at addresses, Bitcoin addresses, holding a balance between 10 till 100,000 BTC. A lot of times those are considered so-called whales. And what we can see here, historically, these kind of addresses, they usually sell into strength, meaning when prices go up, they start to kind of take profits. However, the opposite, when there's attractive entry prices, they start accumulating. And as you can see, especially with the recent dip, those Bitcoin whales have started to accumulate again, which usually is a very positive sign, because yeah, they're more strategic with their allocation and a bit more long-term thinking.
And while 10,000 Bitcoin feels small, to give you the dollar amount, we're talking about at least a net worth of $750 million in Bitcoin held, whether through like an ETFs or through a Bitcoin wallet that basically these investors have. And we're not talking about holders that basically are hosting coins for on behalf of other investors like exchanges or wallet providers. We're talking about individuals, right? So right now, investors with a net worth of at least $750 million worth of Bitcoin or accumulating more Bitcoin since the market drawdowns in a very significant way.
Absolutely, absolutely.
And I think it's good to go back in history again, but I think highlight where we are today, Adrian, right? Can you walk us through how far we've come as an industry to be where we are today, and then talk about the phase where we're going to be moving forward in 2026 when it comes to fundamental investing? But walk us through history from 2011 to 2025 in these different phases of maturity levels that we experience, and where we stand and where we're going to be in the future.
Yeah, I think it is really a return to fundamentals, but it's also always worth to take a look into the past. Of course, some of you might remember the speculation phase, as we call, from the early days in 2010, 11 to 17, and where the bigger bubble burst was definitely with the ICO craze, meaning back then we had IPOs on blockchains. We see new projects launching left and right, and it was definitely driven by retail and also driven by a lot of speculation. Again, here we also had scandals. Of course, MT one of the biggest exchanges back then, went down. But when we talk about institutional readiness, once again, it was very much retail driven. Yes, we had the Bitcoin CME futures, but back then institutions, they didn't even dare to talk about Bitcoin or crypto. I think it all started 2018. Of course, here we went into another innovation cycle, but it was the early innings of institutional readiness. We obviously had the bubble with the NFTs and meme coins, driven by a lot of liquidity and speculative money given of the COVID crisis. And it all came down with scandals like FTX, Luna, Celsius, and the China ban, for instance. But at the same time, structurally, a lot of things happened. It was, the start of US spot crypto ETFs. The UK opened up in Europe, and globally, a clear institutional adoption that is happening across the globe, with asset managers, investment advisors opening up to the topic of crypto. Now, what's really important here, crypto was always retail driven, but we see a clear shift more to institutional money. And those are structural changes that might not be reflected in the price action in the short term. So people really have to zoom out and understand the bigger trend. But what does it mean going forward? And Eli and I would like to call it comes back to fundamental investing, or 2026 going forward are the years of selection. So it's not going to be like this, that you can just throw money into the crypto space and expect everything and all the prices to go up. It's really important for investors to take a closer look at the fundamentals, at potential cash flows, revenues, and really dissect the value proposition behind some of those projects. Because under the hood, there's still a lot of good things happening. What do you think, Eli?
No, I agree. And I think it also comes down to the infrastructure to allow entrepreneurs, corporates, and institutions and banks to be able to operate in a way where they can innovate, but also protect consumers. And I think regulatory clarity, moving away from regulatory crackdowns, as we've seen in the US and China in the previous administrations, is going to be key as well. So, of course, the rise of MICA, the Genius Act, and the Clarity Act, or some of the early innings of where the space is headed. We've seen, of course, a real institutionalization of the mining space as well, moving away from China after the China ban to the US. And the US actually hosts about 70% of the mining market share as well for Bitcoin, which is, of course, a strategic play for the United States of America to have both exposure to the infrastructure and the underlying assets. And then secondly is the blockchain technology is ready for prime time, right? We've seen actually literally on average, smart contracts platforms, think of them as Swift, to be able to actually process payments a lot faster than traditional payment rails like Visa or MasterCard, right? Which basically shows that as the infrastructure gets ready for prime time, the same way the internet was back in 2003, we moved away from dial-up to bandwidth, where essentially we were able to get a better user experience on the internet, where it didn't feel like we had to wait for 10 minutes to send an email and getting the confirmation of that receipt, but actually now getting to a real-time experience. And I think this is exactly where blockchains are today. And that's why we've seen products like, for example, prediction markets that have done really well to provide information to people in real time to understand the world stage when it comes to geopolitical conflicts, when it comes to political elections, or even when it comes to the next Federal Reserve chairman as well, as Polymarket was able to spot ahead of time compared to any other media outlets too, right? So right now, what we're going to be seeing, as Adrian mentioned, is institutional investors and retail investors will have to be selective, would have to look at the fundamentals, whether it's the cash flow, the revenue growth, the user growth, the developer growth. But most importantly, they would have to look also at the consumer applications they're going to be building also the next stage of the internet services that in the future on our phones, we're not going to realize that we're using blockchain-powered technologies or blockchain-powered applications because blockchains are going to become invisible and the complexity is going to be finally on the back end so that people can really enjoy the fast-paced experience of value transfer that they deserve.
Absolutely. Um,
All right, Adrian, we like to talk about analogies with the internet. And right now it feels like, we are in 2003 when it comes down to the stage in which crypto is into 2026. And I like to showcase how far the internet has come, even for Adrian and I to be comfortable and have that conversation today. We are using essentially protocols that were created like 30 years ago, 40 years ago, before Adrian and I were even born, right? And many people actually doubted the internet, but now it feels like laughter or actually a joke. But actually, yes, after the dot-com bubble, and I believe that we experienced our very own crypto bubble as well, as we mentioned with Adrian, when it comes down to NFTs and meme coins and any other primitives that actually drove excess capital. People in the past thought that the internet may just be a passing fad as millions are giving up on it. And it feels like the phase in which we are today, where essentially the technology is ready for prime time. But actually, when you look at fundamentally where we are when it comes to the adoption, we have 700 plus million users that have access to crypto today. And that's about 10% of the internet population, which is very similar to where the internet was in 2003, where at that time we had about 10% of the global population that had access to personal computers and, of course, different ways to access the internet as well. But interestingly, crypto has been one of the fastest growing after AI, the fastest growing frontier technology to be able to reach to that level comparable to the internet, especially in emerging markets, of course. But we believe that in the Western world, thanks to crypto ETFs, thanks to tokenization and over infrastructure plays and consumer plays, we're going to also see that growth catching up to the Western world too. And then, as we mentioned previously, the technology is ready for prime time. Blockchain technology, on average, can process about 3,500 transactions per second, which basically outpace, the speed of Stripe or even Nasdaq at peak hours as well. And then the second thing that Adrian rightfully called last year is that fintech is getting a renaissance, where essentially, financial services companies or neobanks quite struggled after 2014, 2015 until now, because they were basically wrappers of banks to be able to access to consumers and providing, of course, services that the banks would never provide because of the thin margins that these products could be, right? And we're seeing today that most of the financial services organizations are using now blockchain technology itself, whether it's their own blockchain or using public blockchains like Ethereum or Solana, to be able to basically provide faster payments, cheaper payments at a global scale as well. As a matter of fact, yesterday, Gusto, one of the HR systems to process payments and salaries for employees, are now integrating with stablecoins, so US dollars on the blockchain, to be able to actually pay salaries, for example, for employees based in the US. And that's incredibly exciting as well. And then the last thing is, as we mentioned, I think for the last 10 to 15 years, the research and development efforts and investments were really focused on how do we make the infrastructure relevant and how do we make the infrastructure efficient for potential applications. Now it's no longer the question. The question is about which technology is efficient today so that not only can I poke around with a proof of concept as a bank or as a large institution, but most importantly, how do I make sure that I can build consumer applications that can accommodate hundreds of millions of people to billions of people to finally cross the chasm and have the next Google, Apple, and Amazon built on chain. And that's exactly what we're seeing, of course, with Polymarket and Helium. So Helium, we mentioned Polymarket before about prediction markets and how media is reinventing itself with essentially a global prediction markets that allow people to have a better understanding of the odds of specific events in real time based, of course, on information, but also based on the wisdom of the crowd. But Helium is trying to basically create a mobile network. Think about it as, especially if you're based in the US, T-Mobile or Verizon, that allows you to have access to 5G globally. And today we've seen millions of people using it at the fraction of the price that people would pay on a monthly basis. Instead of paying, for example, $150 per month, they will be paying $20 per month for this application, thanks to blockchain technology, which I think for Adrian and I is incredibly exciting.
No, what's the conclusion, Eli? How are we leaning? Is it more bearish, bullish, neutral?
I would say we're in between, right? If we think about the base case right now, I think there are question marks that still need to be answered, right? Especially when it comes to the roadmap for Bitcoin developers to create a step-by-step process to resolve quantum computing, right? There's still a question that some investors may have. I truly believe, of course, gold may have a catch-up trade, or Bitcoin may have a catch-up trade with gold. And I think that's the exciting upside for some of the investors today. But I would say, this is an accumulation phase. This is a consolidation phase, which basically is an interesting opportunity for people, A, to get educated on the investment thesis and the investment case for Bitcoin specifically, and of course, other crypto assets. And then B, of course, understanding how to position themselves in this environment, right? When it comes down to understanding the impact of Bitcoin in the portfolio historically, and we have a lot of research on that as well.
Yeah, I mean, I would agree with you. I mean, as mentioned, obviously here in the short term, Bitcoin price shows some clear weakness, and there's potential risk of further declines. But I think it's really important to zoom out and really see the bigger picture, because
Yeah.
structurally the value proposition of Bitcoin hasn't changed, right? It's still the same asset, and in a world where everything becomes more digital, sentiment can change very, very quickly, and people flock back in. And also from the macro side, I do believe there's a lot of potential tailwinds. As I mentioned, a PMI print has been positive.
Yeah.
Of course, we're waiting for rate cuts. We see how the tone of the new Fed chair turns out. We got some more regulatory clarity coming up. And also, the real economy seems to be at a better state. Of course, in the past, everything was basically captured by the Mag 7, by the big AI companies, while even here we see that, yeah, it's spreading out to also mid and small cap. For instance, the Russell 2000 just broke out from a multi-year consolidation phase.
Yeah.
Let's see if that prevails and if it stays like that. But there could be, in the short term, some catalysts. But again, long term, as a strategic investment, Bitcoin is Bitcoin. It is a digital gold, but in its early infancy.
I agree. And also, I would say gold has a significant head start because before 1971, the dollar was actually backed by gold, right? And of course, gold has been used for millennia. So I do think that there is also the Lindy effect of gold that is incredibly important for asset allocators. But
Yeah.
there is also the complementary aspect of Bitcoin that they are discovering today, and it comes down to education, especially around valuation, portfolio allocation, and then of course understanding better how the technology could evolve eventually as beyond just digital gold as well, which to me of course is incredibly exciting. And people, if they think about the S&P 500 of crypto, well, Bitcoin is actually 50% of the market. So certainly I think it's important to understand that this is the benchmark and the hurdle rate, but nothing has structurally changed when it comes down to the fundamentals of Bitcoin and the investment case of the assets, right? So we're talking about volatility and, of course, macro correlation. But fundamentally, this is, of course, a very interesting phase. And that's why most of the larger investors with at least $750 million in net worth are accumulating more, because they're seeing a clear opportunity to get more into the assets and actually accumulate more BTC.
Absolutely. What do you think? Should we hit some Q&A? Because I already
Yeah,
see a couple of questions coming in.
let's do it.
Maybe, all right. Maybe
There is a
let's take
first
the,
one. There is a first
yeah,
one. And I think that's for you on the impact of institutional regulatory capture of BTC by US institutions when it comes down to the narrative shift, the emergence of dual market pricing with sovereign coins, KYC requirements, and banned coins, right? So basically, Bitcoin is available, of course, in public markets, especially through ETFs. But there are coins that are banned. There are coins that are seized by, of course, the U.S. government. There are coins that have different basically pricing based on where they're traded in public places like market and crypto exchanges. But tell us more about the impact of institutional adoption capture by U.S. institutions.
yeah, yeah. No, that's a very good question. And of course, we shouldn't forget Bitcoin is a neutral global digital asset, and therefore it's accessible to anyone in the world with an internet connection. That's part of the big story. However, the institutionalization, especially in the US, also brought a lot of benefits. I would say ETFs are really kind of the pipelines for those bigger allocators, because as the question implies, there are a lot of regulatory constraints, and yeah, criteria they have to fulfill. So for instance, there could be, yeah, banned coins or coins that, I don't know, were related to money laundering in the past. There's some KYC requirements and so on and so forth. And here, that's exactly where ETFs and ETPs kick in, because they really institutionalize that access. So we know it firsthand, in the back end with traditional APs, a market maker with a primary market and a secondary market. You do have those filters to make sure, yeah, only whitelisted coins, if you want to call it like that, enter into these traditional fund structures.
And I would say, as the asset class matures, and we've seen that with the silver trade as well, between physical and, of course, derivatives like ETFs, we've seen a ratio of 301, which is significant, right?
Yeah,
Unprecedented for silver. And I do think that the ratio between spot Bitcoin allocation through a ledger under your mattress to protect yourself against, like, regulatory crackdowns, or FDR in 1933 seizing your gold. I think like the ratio for spot Bitcoin ETFs and ETPs is going to increase significantly as a share of the global volume for the spot markets. Even though, of course, the futures market is larger, much larger than the spot market, and I think options are going to be catching up as well. When it comes to spot trading, definitely crypto ETPs are going to be a larger capture of spot access. And of course, with traditional payment rails and through brokers and banks, it's going to be very important that, of course, the tainted coins are not touching the rails that wealth advisors or end investors would be able to access to.
yeah.
Unless,
And
of
um,
course,
as
options.
and as you said, I mean, derivatives are just very important in this institutional kind of story, because they're a tool for longer term strategic allocators to hedge themselves and manage risk. But it obviously can also be a tool to tune up risk. But overall, it usually brings more liquidity and more tools for institutional investors to enter that space.
I agree, for sure. We got a second question. It's also relevant for you, Adrian.
Tell
What
me.
danger do treasury companies pose?
Hmm.
Bitcoin is trading close to strategy's average cost price. Companies receive, margin calls and have little access to capital markets. Tell us more about the danger, or at least the worst case scenario that could happen for some of these
Yeah,
DAS or digital assets treasury companies.
that's a very good question, because obviously we see a lot that FUD out there, that MicroStrategy or kind of Bitcoin trades below MicroStrategy's average entry price. But I think it's slightly misleading, because obviously MicroStrategy financed a lot of those BTC purchases via different vehicles, via convertible bonds, via secured notes, via corporate debt. So overall, they don't really face margin calls like a trader would, because most of that debt is also long dated. So prices alone, what I'm trying to say, prices alone, they just don't force liquidation like a lot of people believe they do. Um, it's very nuanced, and it also comes down, I would say, of course, now we're at that break even zone, but the farther down Bitcoin goes, the larger are the unrealized losses, the more reduced collateral value you have for financing, and the lower your multiples for MicroStrategy, the stock as well. So obviously that puts a lot of pressure, but once again, it's not really a immediate solvency crisis. I think we would need to do the analysis, but I know it needs to be dropped significantly, where the company would theoretically face a bigger financial stress, not just a paper loss, so to speak. Now, I like that question because it was kind of something we flagged during last year, but also in our market outlook for 2026. We do think some of those companies might be underwater and some of them might run into liquidations. Why? MicroStrategy, they have been doing this for many, many years. Michael Saylor is very vocal and polarizing, but he has been aligning shareholders for many, many years, and they all at the same page basically. So it also comes down to the capital structure. How are the BTC purchases being financed, and how is it being communicated with all the different shareholders? Now, I don't think all of those DAT companies have that figured out or really have a long-term plan.
Yeah.
And I could see some of them being under pressure, especially from their shareholders, because we know the majority of those companies, they trade at a discount at the moment. Now, we could see a consolidation, but overall, long term, I do think we will only see a few bigger players that really establish themselves as digital asset treasury companies.
I agree. And also, I would say, when people think about the treasury company trade, this is not a direct investment in Bitcoin, unlike crypto spot ETFs that are fully backed with 100% of the Bitcoin in custody, so that they can access it through their bank and brokerage account, right? It's almost like a levered bet on Bitcoin alongside equity exposure of the underlying company that has a real business on the side, but also accumulates Bitcoin to justify raising debt to buy BTC in different ways, through OTC or any other ways, right? So I do think that when they think about this trade, it's almost like the floor of the company is the Bitcoin under management, right? So if, of course, they're trading below Bitcoin under management, it means that the acquirer are able to buy Bitcoin at a discount, which is a very different trade, of course, that people, of course, could get. And to me, I think, to your point, Adrian, and to our 2026 predictions, we are going to see, of course, a consolidation. It's going to be an opportunity for the next Carl Icahn to think about launching an activist fund and acquire Bitcoin at a discount massively, especially in these market prices. So we could see that. But I think the last big boss would be the U.S. government just stepping up and get some BTC as well in this way too. But
Yeah.
I think that would be a far-fetched scenario for now because there are bigger problems to solve. Yeah, watch this space for sure.
We have one last question, and maybe you kick this off. So, what do you think about the future of ETH, Hype, and Sol this year? Obviously, we've been talking a lot about Bitcoin and kind of this store of value proposition, but
Yeah.
what do you think about altcoins, and especially it was mentioned ETH, Hype, and Sol, Ethereum, Hype, and Solana?
So I think it's good for the audience that is not familiar with Ethereum or beyond Bitcoin, Ethereum, Hype, and Solana to compare them with traditional tools that they're used to. So if you have an iPhone today, you basically have an app store, and the app store allows you to download Instagram, download YouTube, to basically attend and listen to our brilliant Adrian during this live webinar, right? And this is exactly what Ethereum and Solana are. They are allowing you to build an app store globally with internet connection so that you can download applications at your fingertips that will allow you to control your data instead of having a company controlling your own data and transferring value, whether it's dollars, euros, Swiss francs, or whatever fiat currency that you have, the same way you would basically send over an iMessage or a WhatsApp message in a very real-time way at a cheap cost, a lot cheaper than basically traditional rails that you would use with Western Union, for example. When we talk about real time, we're talking about milliseconds, right? Like 400 milliseconds for Solana, for example. So this is what Ethereum and Solana are. And then Hyperliquid is essentially a futures exchange. If you're a trader, you know the CME, regulated by the CFTC in the United States of America, that allows you to trade futures without an expiry date, that we call perpetual swaps, that allow you to bet on Bitcoin with leverage, whether it's 2x or 3x or 5x. But that allows you to do that without going through necessarily KYC, for example. And that's accessible through internet connection. Hyperliquid happened to be both the CME as well as an app store, which is very interesting. And the future is very bright, I would say, for these three assets. They are targeting different audiences, although, of course, they're trying to fight for the same bread. Ethereum has been for a very long time, and still today, the longest running app store in the world, with over 10 years of experience and multiple cycles on the back, and I would say scars as well, unfortunately. I think Solana was and has been the cool kid around the corner with basically the same value proposition, but a lot faster and cheaper. And of course, if you're a bank or if you're a merchant, you would want to have lower costs and of course fast transactions so that you can have a better user experience for your clients. So I would say Ethereum is a lot slower and more expensive than Solana. Solana is cheaper and faster. Different positioning. There is a track record, and there is a newer app store that still actually has 5 years of experience. And these are catered to different audiences. And then there is Hyperliquid, which is very interesting because it's both an infrastructure and an application. And the application allows you to basically understand what blockchains can do without realizing that you're using blockchains. And that's exactly what Hyperliquid has been able to be doing. And it has been the most successful consumer application so far, with over $1 billion in annualized revenue for just like 11 or 12 employees, which is really unprecedented. When we compare that with the CME has and makes about $3 billion in annualized revenue for like 3 times as much as the headcount of Hyperliquid. So we're seeing definitely the disruption in the cost, the efficiency of traditional payment rails with Hyperliquid, Solana, and Ethereum, but most importantly also the efficiency of a corporation as well to be able to push the limits. And interestingly, Hyperliquid has been able to provide access to other asset classes than just Bitcoin and Ethereum. We've seen silver, we've seen gold. On Solana, we're seeing pre-IPO companies like SpaceX and Anthropic, which are, of course, very exciting IPOs in the future that investors are looking forward to. SpaceX is going to be actually the largest IPO normally in the world, as they acquired XAI for over $1 trillion in market value. Let's see whether the market will tank or go up. But these are the things that investors can access as well ahead of time on Solana already, which is really incredibly exciting. And of course, on Ethereum, we're seeing dollars and tokenized products, private credits, a lot more than pre-IPO, as well as silver and gold.
Yeah, and I think, as you said, here it really comes down to the fundamentals and for investors to take a closer look. But as we all know, people are very excited about stablecoins, about tokenization, and prediction markets. But these are all use cases and innovation that are building on public blockchains like Ethereum and Solana. So they're really the fundamental layer for all this to happen. And yeah, hyperliquid, I always tell you, Eli, the good thing about hyperliquid, even if prices go up or down, people want to trade futures and derivatives, and hyperliquid is the venue on chain, and
Yeah.
therefore it benefits, and that's why we've seen this kind of price action as well over the last couple of days and weeks. I think, let me check if we have one more question.
I got one more question, and I think that's more catered to you. Thank you so much for the question. The question is, why has Bitcoin dislocated from the gold price?
That's a very good question. Of course, a lot of investors and people are asking themselves, okay, why is Bitcoin not performing? We have this trend around de-dollarization. We are seeing central banks, especially in China, going heavily into gold. But it seems like Bitcoin is kind of left behind, even though the, this time of uncertainty should be actually the time to shine for the digital asset. I would say, once again, short term, I would agree the price performance has been disappointing. But once again, people need to zoom out a little bit. I think sometimes this argument is very short sighted. Uh, I actually think gold caught up with Bitcoin. We shouldn't forget Bitcoin in 2023 and 24 performed over 100% and had a massive rally, and it's taking a breather now. That's one reason. But other than that, both assets are usually have a very low correlation to each other. So historically, we've seen years where Bitcoin performs well. Bitcoin actually, Bitcoin performs well. Gold actually goes sideways, and vice versa. Why? Because yes, they have a similar value proposition on paper, but it's still not reality. They're still driven by different structural drivers. So gold at the moment, due to de-dollarization, due to geopolitical uncertainty, Bitcoin still more tied to liquidity, to maybe the business cycle, to balance sheet expansion, and therefore we see them behaving in a different way. And mix that up with kind of like some macro headlines, with a new Fed chair, with massive leverage in the system, bad sentiment. That all comes together to a way different price performance between the two assets.
And I would say, to add on to what you just mentioned, for the first time in history, I would say, after 2023, when we had the banking crisis with the Silicon Valley Bank that collapsed and went into receivership with the FDIC, so the insurance of the banks in the US, we've seen a dislocation of the price of Bitcoin with basically the banking sector and also gold as well, where Bitcoin went up by over 20% almost overnight compared to the banking sector going down, of course, on the back of the banking crisis. But Bitcoin is a macro asset. And Bitcoin has been a macro asset. And on the back of being a macro asset, the second largest economy in the world, being China, banned completely Bitcoin, whether it's trading or mining. And China has been right now in a very interesting position where they have a head start in, of course, the energy infrastructure compared to the US. But most importantly, China has been able to start the de-dollarization of US treasuries in a significant way, especially more on the back of the tariff war that we've seen last year, which means that the first asset that comes to mind for central banks, but also even for high net worth individuals in China, is actually gold, because they're not allowed to touch Bitcoin. And Bitcoin, of course, is almost like the plague in China because it's completely illegal, right? So if Bitcoin was legal in China, it would have been a very different story. And we would have seen probably a complementary asset allocation from the central bank, but even also from individuals to be able to allocate into Bitcoin. And we're talking about billions of dollars to trillions of dollars in treasuries allocation now to gold, right? Which basically translates into this price action and also is the face of the geopolitical conflicts that we're seeing today as well, right? Similar stance as well in China. And that's why we're seeing, of course, gold catching up to that geopolitical stance that we're experiencing today, where essentially multiple companies and economies in the world are moving away from the dollar, but thinking about gold first instead of CNY or the Japanese yen, because gold has been, of course, the first commodity to think about, right? And I think that's why in the future we're going to see that Bitcoin is going to also be in that conversation moving forward, but it's very early on, right? So going back to what Adrian and I mentioned, when it comes down to the phases of maturity that we are today, right? We mentioned specifically that in the three phases, we're seeing that Bitcoin is getting into fundamental investing because we've seen institutional readiness, right? And that institutional readiness that we experienced 2 years ago with the first public ETFs in the US is going to be basically planting the seeds for what we could be experiencing from patient capital, whether it's pension funds, right, or insurance companies, and eventually central banks to think about a Bitcoin allocation. This is very early. Gold has a head start, rightfully so. But I think this is interesting to watch this space. But to better understand the dislocation is to look at the geopolitical landscape today.
All right. Do we have any more questions, Eli?
No, we don't have any more questions. I'm not going to share my screen again because I think it's good to look at Adrian. But I want to tell the audience, if you're looking at getting more information about 21shares and our phenomenal research, check out our website, 21shares.com. You would find insights, whether it's weekly newsletters or our even like 2026 predictions that you can find online as well. Of course, feel free to reach out to us as well directly at research@21shares.com. If you prefer to, of course, reach out to us directly and have specific questions, of course, we're here for you. You can follow us on social media as well. You will find our social media platforms on our website, whether it's Twitter or X or LinkedIn as well as Instagram. But thank you so much for your time, and stay tuned. Watch this space.
Bye, Eli. Thank you.
That was a pleasure.